Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Sweeping new US tariffs come into effect. 60 global economies hit with levies of at least 10% after a forced labour probe as President Trump rebuilds his tariff wall. Elsewhere, Brent crude holds above $100 a barrel as the US threatens to intensify Iran strikes. Global tensions and fading tech sentiment hit stocks. And ECB President Christine Lagarde lays the groundwork for a September rate hike, warning of upside risks to inflation. We'll speak exclusively to the Austrian National Bank Governor, Martin Kocher. Well, happy Friday, everybody. Here is the picture in markets. Stocks dropping in the Asia session, down more than 2% on the MSCI Asia Pacific Index, as traders are increasingly jittery on the AI rally. The futures picture pointing to tepid sessions both sides of the Atlantic. And if you flip cross-asset, you can see the other thing weighing on sentiment this morning is that surge in oil prices. Brent holding above $100 a barrel on the supply fears. We're up about 38% so far this month and set for a weekly jump. So that reigniting concerns around inflation, prompting traders to price in prospects for higher rates. So you've got Treasury yields at 2026 highs. The 10-year here at 4.70%. Already jumped 4 basis points yesterday, and euro-dollar pretty steady as investors weigh further escalations in the Middle East. Very little reaction to the latest breaking ECB lines. We've just heard from the Bundesbank President Joachim Nagel after yesterday's ECB hold, saying it was right to keep rates steady this week. But the Governing Council still facing intense uncertainty, and so he's nodded to a potential move in September when, of course, the ECB will have new data and projections. Let's take a look at the risk events on the agenda for today. At 7 a.m. London time, top of the hour, we'll get the latest UK retail sales numbers, expected to slip in June. Then for consumer confidence data coming out of Germany, that will be at 7 a.m. London time as well, the GfK numbers. And then from about 8:15 a.m. London time, we'll get a raft of global PMI data. So plenty of reads on the global economy. Let's set you up for the day ahead. We begin with President Trump rebuilding his tariff wall with new levies on 60 economies. As of just after 5 a.m. London time, US tariffs of between 10 and 12% kicking on most of America's major trading partners. Now, it follows an investigation into the alleged failure of those economies to prevent forced labour in their supply chains. We can get more now with Bloomberg's Rosalind Matheson. Ros, good morning to you. The Trump administration, I must say, says this isn't just a pure replacement of the earlier duties struck down, of course, by the Supreme Court. But when you look through these, how different are these new tariffs from what was there before? Will they have a significantly different economic impact in a year of the midterms when the backdrop is higher oil prices?
Well, yes, it really is about rebuilding that tariff wall, but doing so in a way that might be stickier and more durable than it was previously. So using those investigations under the acts versus executive action using emergency powers. And none of this is really that surprising. It was expected to come. It was flagged already. It is a fresh headache, of course, if you're an importer or a company having to deal with quite complex arrangements around exemptions for fuel, for food, for fertilizer. This doesn't impact sectoral tariffs, so things like autos and metals, and the complication of making sure it doesn't upset your existing bilateral trade deals. So a lot of complexity in there. But what might it mean economically for the US? Well, that might not filter through till after the midterms. So perhaps Donald Trump can say, look at me, I'm protecting US workers, bringing jobs back, protecting US companies. But the reality is that tariffs come through importers and affect the American consumer. And we've seen that already in the various tariff actions so far. The end result does tend to be on the American consumer, and that's at a time when prices are already under pressure in different ways, but particularly from that ongoing conflict in the Middle East, which has had a global impact on prices for oil, for other commodities, and for things like food. And that's filtering through to the US as well as other parts of the world. So this would probably have a negative impact on American consumers, but the specific impact of this may be felt only in some months past the midterm elections.
But is it likely that these new duties, Ros, will make it through the courts, given the last ones didn't?
Well, they'll probably face some kind of legal action. We've seen, again, importers particularly taking those legal steps, individual legal actions, saying this is unfair on us and we're carrying the burden of this. But the idea, again, is to make this more durable and stickier. So you're using investigations under this Trade Act of the 1970s and saying we've conducted these investigations in accordance with that legislation, and now here is the end result. And this one is obviously around allegations of the use of forced labour in your supply chain. And there are other investigations ongoing around issues like excess capacity that we still need to see the results of. So trade experts say this is about making it more durable, probably less susceptible to those legal challenges. And again, that's why you're also seeing countries probably say at this point they're not going to choose to retaliate. So any changes to this probably won't come through the courts necessarily. You would hope, if you're an importer or a company, that it comes through the political level. So there's political negotiations to carve out further exemptions, for example.
OK, really interesting. Ros, thank you so much. That's Bloomberg's Ros Matheson. Well, those tariff tensions and a downturn in tech sentiment are hitting stocks in Asia this morning. Let's get a read on how markets are faring there with Winnie Xu out of Hong Kong. Winnie, what we should be watching?
Yeah, good morning, Lizzie. We are really seeing a risk-off day in Asia as we head into the weekend. Now, as you just mentioned, these tariff threats, but on top of that, we are also seeing the higher oil prices, oil topping $100 per barrel, weighing on these net oil importers in Asia. That's why we are seeing MSCI Asia here down more than 2% after 3 days of gains, with South Korea's Kospi index here leading declines down about 5% here. Now, flip the board, we also see Japanese stocks falling, tracking those losses, with the tech stocks, in fact, Nikkei 225, the tech gauge, underperforming the broader Topics index. And in fact, on the Topics index, one of the only sub-gauge that is rising is the financial sector. And that is on the expectation for the Bank of Japan to raise rates to combat inflation. Now, speaking of inflation, because of the higher oil prices pushing the inflationary outlook, as well as central banks to raise rates further, we are seeing further pressure on the region's currencies as well as bonds. Now, when it comes to Japanese yen here, weakening overnight and inching closer to that $164 levels against the dollar. Now, that is also on track for its worst week in more than 2 months. So really, sentiment has been turning for the Japanese yen. We did have the key gauge for inflation picking up, and that goes to show how the expectation for the Bank of Japan to raise rates this year remains alive. But when it comes to next week, we are still expecting the central bank to stay hold. Now, flip the board, we take a closer look at the technology shares, because tech sector today leading losses in Asia. Well, the revenue forecast from Intel is supposed to be good news for the sector. However, that is being outweighed by these concerns around the massive spendings of U.S. hyperscalers. And on top of that, specifically for the Korean memory chip makers, Samsung Electronics and SK Hynix, they will be facing a big competitor coming on Monday. We have China's memory giant CXMT having its IPO on Monday, and we are seeing investors trimming some of these positions on the Korean memory chip makers ahead of this event. Back to you, Lizzie.
Winnie, with the view from Asia, thank you very much. That's Bloomberg's Winnie Xu. Well, zooming out, as she says, this week's tech earnings really have heightened investor concerns over just how much big tech is spending on AI. Yesterday, the Magnificent Seven suffered its biggest one-day drop since the tariffs chaos of April. And we can get some perspective now with Ven Ram, cross-asset strategist at Bloomberg MLive. Ven, it feels like every other day AI jitters knock market sentiment. Then we get a bounce back. At what point does this cross into bubble bursting territory?
Well, I think we are getting pretty close there, Lizzie, if you ask me. I mean, if you looked at the Philadelphia Semiconductor Index earlier this week, you would have noticed that year to date, every one of those stocks listed there, regardless of their merit, their quality, their return on equity, they were all bid up and they were all winners for the year. So basically, the markets were saying, you know what, We don't know who the winners are going to be, but we are betting that every one of those entrants into the AI space is going to be a winner. But that's not how it works in real life, as we know, Lizzie. Back in the start of the 20th century, when Henry Ford invented the Model T, famous Model T, and then we had a proliferation of automobile companies in the US. At one point, we had something like 1,000 companies in the US landscape. Now, if you look at the S&P 500 or even the broader Russell 3000, there are just a handful of companies. You could just count them in your fingers. And if you look at the combined market cap, it's just about $150 billion, excluding Tesla. So the markets are suddenly getting to the realization that, look, not everyone is going to be a winner, regardless of how we price them. If you look back again towards the internet bubble, dot-com bubble era, Netscape was listed at 4 billion or something like that for that day, which was humongous back in the day. But then Netscape is not even in use now. So, the idea that AI, everyone is going to be a winner, is what is being tested, and I think that will continue to be tested in the weeks to come.
I love the historical context, Ben. Thank you very much. That's Ben Ram, cross-asset strategist at Bloomberg Live. Have a great weekend. Well, let's focus on European tech because SAP's cloud revenue beat expectations in the second quarter, growing 24% in constant currencies to 6.28 billion euros. Now, it comes as customers of the continent's biggest software company accelerate their migration away from on-premises software ahead of SAP's legacy support cut-off deadline. We can get more now with our tech editor, Mark Anderson. Mark, good morning to you. So we've been talking about the threats from AI to software, but it seems like SAP, at least, is doing well enough to impress investors.
Yeah, I mean, I think these results show that SAP is on track in its transformation from a software as a service company to a AI enterprise AI provider. It's made this cloud division the focus of a business strategy, and it's really aggressively pushing clients to adopt those services, which is very much key to the success of this transformation. But of course, it's not really an easy transition for customers to make. It's very time consuming. It's expensive. It comes at a time when there's a protracted war in the Middle East, which has upended some of the supply chains in very important sectors for SAP, like oil and gas. So that's made it quite difficult. But these results show that SAP's managed to get clients to move over. And of course, investors like that because it comes at a time when there are all these fears about impending SaaS apocalypse.
Yeah. Well, we've also had, really incredible results from Intel, a jump in revenue forecast, shattering estimates. What's Intel doing so well right now, especially when, it struggled for so long?
Yeah, I mean, I think at the heart of those very strong results from Intel is Intel's data center division, which posted growth of about 60%, more than double the pace of the overall business. So, CEO Lip-Bu Tan has told Bloomberg that demand for his chips is outpacing his ability to supply them. And I think what we're seeing is that Intel is working very hard to improve production processes and boost supplies, and it is now confident that it's going to be able to capitalize on that demand in a way that it wasn't able to previously.
So then as we look ahead to the European cash open, how much upside could we see for the European chip makers off the back of those Intel results? I'm thinking about players like ASML in particular.
Yeah, it'll be interesting to see, won't it? But I think, what we can really tell from this, from these strong results from Intel is a fundamental shift in the AI industry, which is benefiting Intel in particular, and I'm not sure other European chip makers would share that benefit. The shift is going from training AI models, which is of course very much dominated by NVIDIA's advanced AI processors, to running them day to day. That day-to-day operation is benefiting Intel because, of course, you need things like CPUs and microprocessors that Intel is famously good at producing. So yeah, Lip-Bu Tan did tell us that he's, top of his mind is positioning Intel as a key beneficiary of AI spending, which, as I'm sure we've noted, is running away to historic levels. And I think this shows that Intel might be in a good position to finally capitalize on that after years of struggling.
OK, really appreciate the context, Mark. That's Bloomberg's Mark Anderson. Thank you. And we're going to get another perspective on all of this later on this morning. Christian Klein, the CEO of SAP, will be joining the opening trade for an exclusive conversation at 7:30 a.m. London time. But still ahead, right here on Daybreak Europe, we'll be having an exclusive conversation with the ECB policymaker Martin Kocher as rising energy prices fuel bets on a September rate hike. But first, why are those bets being fueled? Well, supply fears are pushing Brent crude above $100 a barrel. So we'll dig into the oil outlook on the geopolitics of the Middle East and Russia next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Well, we are looking at Brent holding above $100 a barrel, set for a weekly jump after President Trump threatened to escalate strikes on Iran and hold the country responsible for any attacks by the Yemen-based Houthis on ships in the Red Sea. For more, I'm joined by Bloomberg's Stephen Stapczynski. And Stephen, good morning. It is the 13th night of tit-for-tat strikes we've had here. The Houthi attacks on Saudi oil tankers as well. How desperate is the global energy supply picture at this point?
It is getting worse every day. I mean, I think, we're not in a situation where people aren't getting their shipments and there is no oil, but we are getting to a situation where the amount of supply in storage is declining every day, which, if this continues, threatens to create a crunch in the next few weeks or months if we don't see resolution. I think one thing in particular that has worried the market has been the Houthi rebel attacks in the Red Sea, targeting Saudi oil tankers. Now, that's been a very key part for Saudi Arabia rerouting its oil out of the Persian Gulf into the Red Sea through the Bab al-Mandeb Strait to customers in Asia. That means that they were able to avoid Hormuz. They were pumping about 7 million barrels per day at export terminals in the Red Sea to get that oil out. But now, without that option through the Bab al-Mandeb Strait, they have to go north through the Suez Canal, through the Mediterranean, around the Horn of Africa to Asian customers. That adds weeks to transit. It makes it more challenging to get the oil to the customers that need it in Asia. Now, again, there have been, customers have been able to find alternatives in the near term, but if this continues, it does potentially result in higher prices for customers in Asia that will also spill over to Europe and the rest of the world.
And it's not, of course, just the Iran war that's hitting supply. You've had Moscow warning that its Black Sea waters are unsafe. We've seen Kazakhstan cutting oil production. What's the relative significance of that for markets, Stephen?
Yeah, I mean, this is all happening at the worst possible time. It's a perfect storm of key waterways sort of being restrained. So the Black Sea, while it is a Russian port, there is a port there that connects to the CPC pipeline. It ships 80% of Kazakhstan's oil production. And with that being in danger because of Ukrainian attacks, no longer are they able to get the ships there. That Kazakhstan oil shipped from that port makes up about 1 to 1.5% of seaborne oil supply. So it's not an insignificant amount. And when you take into account reduction in those flows, as well as flows through the Bab al-Mandeb Strait in the Middle East, as well as the Strait of Hormuz, you are facing a situation where the market is quickly getting tight. And in particular, this Kazakh oil via the CPC pipeline, it's a grade that you can't easily replace. There are refineries in certain parts of the world, including Europe, that depend on it. And so now you're also looking at a potential situation where the fuel supply begins to also tighten. Diesel prices are already rising. The refining price that you can get for producing diesel has also surged. And so you could see this also starting to hit the downstream markets where it affects consumers and adds to inflation.
OK, really appreciate the context. Stephen Stupczynski there. Thank you very much. Well, coming up, we'll bring you exclusive interviews with the daughters of Africa's richest person, Aliko Dangote. We'll be hearing from Fatima Dangote about the refinery business's upcoming IPO. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, the daughters of Aliko Dangote, Africa's richest person, are taking on greater responsibilities in the family business in a bid to build the conglomerate into a $100 billion industrial group within 4 years. Bloomberg spoke exclusively to them in their first interviews in their new roles. Fatima Dangote, who leads commercial operations for the petroleum refinery, spoke about its upcoming IPO.
Yes, it's good that there's one of the biggest IPOs about to happen within the continent. But for me is the participation of both Africans and people outside of Africa into this story that the Dangote Group is trying to sell. When you look at it, Nigeria in particular has been exporting crude oil and importing refined petroleum products. But this refinery has changed that narrative or equation, whereby we're now having to add value to our natural resource here within the continent. And we're having to now be a net exporter of jet when you look at it. When you look at the second quarter of products, jet in particular, that went into Europe, you see that 25% of that volume came from the Dangote refinery. So we're selling a story that Africa is able to industrialize at scale, not just at scale, but at a global scale. It's telling a story that Africa is able to conceive an idea, finance it, and manage a mega project at a global level. So it's not just IPO selling shares. It's showing the world that Africa has entered into the new phase of industrialization.
That was Fatima Dangote speaking exclusively to Bloomberg's chief Africa correspondent, Jennifer Zabasajja. Now, let's take you to some other top stories we're following for you around the world this morning. The US House has again called on President Donald Trump to halt the war on Iran, with 4 Republicans joining Democrats. The largely symbolic War Powers resolution passed by 214 votes to 208, marking the second such vote since June. And elsewhere, Singapore's sovereign wealth fund GIC will deploy an extra $30 billion into hedge funds over the next 3 years. GIC's group CIO told us it has already tripled its hedge fund investments over the past decade without giving an amount. Well, coming up on Daybreak Europe, as oil prices climb, so do rate hike expectations. Our exclusive conversation with the ECB policymaker Martin Kocher is coming up next on Daybreak Europe. Stay with us. This is Bloomberg. Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. Sweeping new US tariffs come into effect. 60 global economies hit with levies of at least 10% after a forced labour probe as President Trump rebuilds his tariff wall. Meanwhile, Brent crude holds above $100 a barrel as the US threatens to intensify Iran strikes. Global tensions and fading tech sentiment hit stocks. And ECB President Christine Lagarde lays the groundwork for a September rate hike, warning of upside risks to inflation. In just a moment, we'll be speaking exclusively to the Austrian National Bank Governor Martin Kocher. Well, let's take a quick check of these markets. Happy Friday if you are just joining us, 6:30 a.m. here in London. And we have still got stocks dropping in the Asia session by more than 2% on the MSCI Asia Pacific Index. We are also looking to a pretty tepid start on both sides of the Atlantic. Euro Stoxx 50 futures are only up 0.2%. S&P E-minis are just flat to the upside, but Nasdaq futures down 0.1%. Flip cross asset, and you can see partly why it's not just just the jitters around the AI rally. It's also, of course, because we've had this surge in oil prices. Brent holding above $100 a barrel on the supply fears. We are set for a weekly jump, and that reigniting concerns around inflation. So traders pricing in prospects for higher interest rates, Treasury yields at 2026 highs, the 10-year yield at 4.70 there, so currently up a basis point, but we already saw it jumping 4 basis points yesterday. And meanwhile, we've got one eye on euro dollar, just holding steady at 1.13. Not much reaction to the latest ECB lines. We've been hearing from the Bundesbank president, Joachim Nagel, earlier, nodding to a potential move in September when they'll have new data and projections, but really just saying that it was right to keep rates steady this week. Now, let us turn to our front page news this morning. The Wall Street Journal focusing on surging oil prices, saying that the energy spike threatened the US economy, as well as Republican hopes for the midterm elections. Meanwhile, the Financial Times leads on tariffs as President Trump rebuilds his tariff wall after losing, of course, his levies battle in the Supreme Court earlier this year. And then if we come to the UK, the Times this morning says that energy industry sources say they've been given indications the new Prime Minister, Andy Burnham, will move quickly to scale up oil and gas production in the North Sea, with a decision on drilling in the country's biggest underdeveloped sites due within weeks. I'm sure that will please President Trump. Well, you can get a roundup of all of the stories you need to know to get your day going in today's edition of the Daybreak newsletter, which as ever, terminal subscribers can find by going to DAYB Go. Now, let us turn to some breaking earnings from Volkswagen. Analysts had been expecting profitability to remain within the full-year guidance despite all of the headwinds. You've got US tariffs, you've got the China slump, you've got the weight of waning sales of Audi and Porsche models. The red head just crossing the terminal is that they see full-year revenue between a loss of 3% and 0%, where they had seen 0% to a gain of 3%. So pulling that back, they also say that they had second quarter operating margin just shy of the estimate, 4.2% compared to an estimate of 4.79%. Second quarter operating profit, 3.47 billion euros compared to an estimate of 4 billion euros. So again, a miss there. And full year revenue, full year automotive net cash flow, they see between 3 billion euros and 6 billion euros. So those are top lines out of Volkswagen, and we shall be analysing these results later on in the programme with Oliver Crook. We'll also be speaking to the CFO of Volkswagen, Arno Antlitz, on the opening trade just after 8 a.m. London time. But let's turn back to the ECB now, because President Christine Lagarde yesterday laid the groundwork for a possible September hike after the ECB held rates steady yesterday. As the widening conflict in the Middle East pushes Brent crude above $100 a barrel, Lagarde says that the central bank remains vigilant on inflation.
We will be particularly attentive to any risk of second-round effects. I think it's clear to all of you, all of us, that there are direct effects. It goes without saying that there are indirect effects when you look at the price of, say, transportation, for instance. Pretty obvious. Second-round effects, we are not seeing it.
Well, joining me now for an exclusive conversation is Martin Kocher, Governor of the Austrian National Bank and, of course, ECB Governing Council member. Governor, it is great to have you back on Daybreak Europe. Thank you so much for making time. Let me start by asking whether you were one of the Governing Council who considered a hike at yesterday's meeting.
So good morning. Thanks for having me. We considered, of course, all the options yesterday. We looked at the data, as always, and there is recent developments on the oil markets that are concerning. There is, of course, other data we look at. There's a set of considerations that is important for us. I remind you that we hiked in June, and we thought we are in a position that allows us to analyze the situation, be vigilant for the next couple of weeks. But we are in a position that allows us to see whether the incoming data of the next couple of weeks, that's PMI data, that's of course inflation data, but also other data, that this data points in the direction of a hike or a hold in September. And so the decision was to hold yesterday. And what President Lagarde said in terms of the options, I can just echo it's exactly what the discussion was in the Governing Council.
Well, at the moment, are you already seeing second-round effects from the conflict in the Middle East into the Eurozone economy? And if you think they're still in the pipeline, when do you think that those second-round effects would start to show?
So first of all, we don't see any hard evidence of second-round effects. We see direct effects, of course. We see indirect effects. That was also mentioned by President Lagarde. But we don't see more than anecdotal second-round effects. Second-round effects will be mainly associated with wage developments. We're looking at that very closely. We'll see how that pans out over the next couple of weeks and months. This will clearly be crucial. But there's also other effects on prices that we are looking at. We had a lot of attention on oil prices. Recently, natural gas prices are the point of attention for us, but also other prices, food prices, not related directly at the moment to the conflict in the Middle East, but perhaps related to El Nino and other events, weather events, climate change. So these kind of things matter for us, but it's a set of considerations. These data are always available for the meetings, and we discuss them in detail and see to what extent they might drive inflation expectations and inflation in the future. We have to, of course, have a picture of how the inflation looks like in half a year from now, because that's relevant for monetary policy considerations.
Well, yeah, I understand that you're going to be completely data dependent. You'll be watching the developments diplomatically in the Middle East. But right now, at this point, do you see a hike in September as the most likely outcome?
That's a good question. And if I knew, I would tell you, indeed, the volatility of the situation is reflecting our framework guidance. I think everybody knows the reaction function of the ECB. We're determined to reach our medium-term target of 2% inflation. But a lot of things can happen until September. And the meeting-by-meeting approach that is suitable, not for every situation, is particularly suitable for the volatility, the fragility of the situation we are having at the moment. So I cannot tell you, but we'll, of course, assess the situation. And I think everybody knows if the inflation outlook becomes worse, if there is a situation where inflation expectation deteriorate, for instance, the medium-term ones, then there is the necessity to act. But we are well positioned to act at any time and well determined to act to defend our 2% target.
Well, let's put it the other way. What would mean that you don't act? What if there's a return to diplomacy in the Middle East, we hope? What if there's a drop in oil prices and it's sustained? Under what conditions would September be off the table?
When you look back a bit, we had the June meeting, we hiked, and a couple of weeks after the June meeting, there was a situation where it looked as if the conflict in the Middle East is easing. It looked as if the oil prices go down. Actually, for some days, oil prices were clearly below our baseline scenario for the future outlook. And if that happens again, of course, we have to consider what we are doing. It doesn't mean that we don't hike. It doesn't mean there is a clear point for a hold. But it is clearly the case that the Middle East conflict, its duration, the risks involved in what's happening there in terms of any kind of agreements, that this conflict is at the moment key for monetary policy. And if developments on the ground that we all hope for, peace, a sustainable peace, are achieved, then this might, of course, influence what we are discussing in September. But it's a couple of weeks down the road, so we'll see what's going to happen.
But in a worst-case scenario, you would be open to considering a 50 basis point move or even multiple hikes, perhaps?
Hopefully, we don't have to talk about worst-case scenarios at the moment. This has not been discussed, but we do everything to reach our medium-term target, and we'll see what that takes.
And does the risk of recession worry you? You know, you've got growth only expected to be modest going forward. If you had to implement that more forceful policy response, are you worried about the risk of recession?
The growth outlook is for the euro area is not great, but we are far away from a recession. At the moment, the European economy is quite resilient, given the geopolitical developments and given also other developments that influence our growth outlook. So there is no risk of a recession at the moment. I mean, you can always imagine, of course, events unfolding that lead to a rapid change of the economic outlook. But at the moment, both the labor market but also the overall economic development is resilient. But of course, it's subdued by the events and especially by the uncertainty that leads to postponement of investments, postponement of consumption. On the other hand, this is an upside potential that's also mentioned in the monetary policy statement in the press conference, that it could turn out better if events unfold in a way that supports more certainty for the future.
OK. Governor, I also just want to play a little more of President Lagarde's speech at the press conference yesterday. Let's just take a quick listen.
You are not going to see the back of me before 2027, OK? And second, what I said, that 2027, my dear, OK? And the second point that I would mention is the same that I did mention once. When there are clouds on the horizon, the captain stays on the ship. And this captain is staying on this ship.
The captain stays on the ship. Governor, do you think that perhaps she protesteth too much? Do you really think that President Lagarde is going to stay on till the end of her term?
So I'm fully convinced. She said the captain stays on the ship and the clouds are on the horizon. And I think clearly everybody agrees clouds are on the horizon at the moment when we talk about economic development, when we talk about geopolitical risks, when we talk about the threat of inflation. And the ECB is doing a good job. And we are fighting inflation at the moment. We are well positioned. And there's nothing to add. I think President Lagarde said everything regarding the question that was raised in the press conference.
OK. Governor, really great to have you back on the programme. Thank you so much for making time this morning. That's Martin Kocher, Austrian National Bank Governor and ECB Governing Council member. Well, coming up, Volkswagen says that full-year revenue will now fall after second quarter operating profit missed estimates. The stock indicated lower on TradeGate as we head towards the European cash session. We'll bring you all the details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, we have Volkswagen falling on TradeGate this morning ahead of the European cash session after it cut its full-year revenue forecast. The German automaker says that competition in China is intensifying. So let's get some analysis now. We can go to Bloomberg's Oliver Crook, who's been diving into these numbers for us. And Ollie, it does not look like a pretty picture for Volkswagen this morning.
Not particularly, Lizzie. It's gone kind of from bad to worse. This was supposed to be an earnings release where you actually look back in the second quarter and you say, actually, there's nothing to see here. Things are relatively stable. We're going to give you some more detail on the guidance going forward. And, of course, the restructuring plan and the cost-cutting plan. But what we got is the following. In the second quarter of the year, we have the margin coming in at 4.2%. That is below the estimate of about 4.8%. Obviously, margin pressure is absolutely key for Volkswagen, for the broader European auto market, as you have all all of these Chinese competitors coming into, of course, the Chinese market, but of course the European market. You look at the second quarter operating profit coming in at 3.47 billion euros, again, below the estimates of 4.07 billion. But of course, what we're watching very closely, as ever, is the guidance going forward. The full year operating return on sales is going to be between 4 and 5.5%. That is in keeping with what the estimate is, about 4.5%. You do have to ask yourself, though, Lizzie, if you're not able to hit that operating margin target in the past, how are you going to hit it in the future, particularly if you're having difficulty cutting some of the costs, which is, of course, the main story of Volkswagen, which we can get into a little bit more, but also looking in full-year revenue. This is the other sort of metric that jumped out to me. Full-year revenue for 2026 going to be either negative 3% to 0. Previously, it was at 0 to plus 3%. Now, we also dive into the geographical areas in terms of what we saw for the first half of the year. We saw growth in South America up 5%, growth in Europe up 1%, Western Europe is up 1%, Central and Eastern up 10%. However, that does not offset the loss that we saw of vehicle sales in China of 31%. So there are a lot of threads to sort of unpack here as we get into the earnings report. And of course, we'll be speaking to management a little bit later to help us get a clear idea of how Volkswagen is going to turn this around.
Yeah, you mentioned some of them, but just so many headwinds facing this company at the moment, from rising sales in China to the transition to EVs, the talks with the unions, tariffs as well, of course, coming out of the US. What is the plan right now for Oliver Blume?
That is the big question for investors. I mean, let's just talk about the three major regions that you have for Volkswagen, right? You have the home market of Europe, where you have Volkswagen having about a 25% market share of the entire market in Europe. If you look at the last month in terms of sales of plug-in hybrid vehicles, Chinese competitors took more than a third of the new sales within Europe last month. That is just the month of June, and we should say that is still with European buyers paying tariffs, i.e. paying a premium, because these cars are still being built in China and being shipped over to Europe. In the coming months and in the coming years, these are cars that are going to be produced here in Europe. That is going to bring the cost of those cars even further down. It is going to bring the price tag even further down. That is the big market concern here in Europe. In China, you see them losing, a third of the market, potentially losing 31% in sales in the first half of the year. That is a major story for Volkswagen. It was the big growth driver. We have seen the Chinese market stall out, because of the weakness of the economy, but again, back to the main issue, which is competitors within the Chinese market, to say nothing of the United States, where you've, of course, had the tariff concerns. You have them sort of trying to bring out this new brand Scout, which they don't have off the assembly lines yet, to try to be more competitive within the United States. But what you see is a very, very difficult outlook for Volkswagen. You saw it on the price chart there for the stock. The stock is at the lowest level it's been since 2010, so this is going to be a very active discussion that we'll be having with Volkswagen management a little bit later. We'll be speaking to the CFO in terms of the turnaround plan. The big issue they have, Lizzie, is they are not able to cut jobs. There are very powerful unions within Germany. They want to cut 100,000 jobs. They want to close factories. That is intensely difficult for them to do, particularly when they're dealing with competitors from China who have none of these constraints.
Ollie, thank you so much. That's Bloomberg's Oliver Crook just running us through the numbers from Volkswagen and the outlook ahead. And as he says, we're going to be speaking to the CFO, Arno Antlitz, on the opening trade just after 8 a.m. London time, so don't miss that interview. Now, let's take you to some other top stories in the world of autos this morning. US car safety regulators are working on making it mandatory for vehicle door release systems to be safer and more obvious. It follows cases in which people have been trapped inside cars when the electric doors have lost power. Bloomberg has uncovered at least 15 deaths after people were unable to open the doors of Teslas, which had crashed and caught fire. Staying with Tesla, a steep sell-off in Tesla shares has turned into a major payday for its short sellers. The stock fell as much as 15% on Thursday, yesterday, its worst drop in more than a year after earnings missed estimates. Analysts say that the sell-off has left investors who bet against the stock poised to make about $4.3 billion in one-day mark-to-market profits. Well, we'll have plenty more on the programme. We'll bring you a couple of terminal charts to frame your day ahead, so don't go anywhere. Good morning from London. This is Bloomberg.
we think that the capex headwinds are going to continue, but 80% is already growing at about 8%. We want to put a lot more focus, so we're going to direct a lot of the team with forward deployed engineers, with people who are focused on deploying the software at clients, much more technical help, and make that 80% grow even faster.
The IBM CEO Arvind Krishna speaking there and picking up on that capex theme. Of course, we started off the Mag 7 earnings this week, and Alphabet's decision to raise its 2026 forecast for capex over $200 billion amplified that broader tech sell-off that we saw yesterday. In fact, it was the worst day for Mag 7 stocks since the April 2025 tariff shock, as you can see here, and the continued plunge for Tesla adding to that damage. But flip the board over, because it's not just the tech sentiment that's been weighing on stocks. It's also, of course, the fact that we've got oil back above $100 a barrel on Brent. That fueling expectations on Fed hikes. In fact, September Fed hike bets are at a record high, so the blue line here. But flip the board one more time, you can see the impact on the bond space. Markets pricing higher for longer, and the 30-year yield back above 5%. The opening trades next. This is Bloomberg.